Imagine waking up one morning, checking your bank account, and finding your money frozen. Not stolen, not hacked, just inaccessible. Sounds like a movie plot, right? Well, in 2023 alone, over 500 regional banks in the U.S. showed signs of liquidity stress, and it's only gotten worse since then. People who thought their money was safe got a brutal wake-up call. Let's talk straight. Your cash is quietly being devalued. Inflation isn't just a temporary nuisance. It's a silent thief. Every dollar sitting idle in your savings account is losing its power, its purpose, and ultimately, its value. And while you might feel safe keeping your money liquid in the bank in today's world, that may be the riskiest move of all. Here's the brutal truth. The system that once protected your money is now designed to control it. Central banks are rolling out CBDCs, digital currencies with programmable features that could restrict how and where you spend. Add in global debt, economic instability, and AI-fueled job disruption, and suddenly, your cash doesn't seem so safe anymore. Not to mention, negative real interest rates mean you're paying to save. So what are the smarter alternatives? Where can you park your wealth without watching it vanish month by month? In this video, we're uncovering 7 assets that are safer than cash in 2025. These aren't just investment ideas. They're strategic tools to protect your freedom, your purchasing power, and your future. We'll break down what they are, why they're outperforming savings, and how you can use them to outsmart the system. If you're holding a big chunk of cash in your bank account, this video could change everything. Let's dive in. The hidden risks of holding cash on the surface. Keeping your money in a bank seems like the safest, most responsible thing to do. It's protected by government insurance, right? You can access it anytime, right? But here's the part nobody talks about. Safety and security aren't the same thing. And in today's economy, cash in the bank is far from secure. Let's start with inflation. Every year, your money loses value. Not because you spend it, but because the system silently erodes its worth. In the last 3 years, the U.S. dollar has lost over 20% of its purchasing power. That means $10,000 in your account today buys significantly less than it did just a few years ago. And with the ongoing cycle of money printing, debt monetization, and geopolitical instability, inflation isn't going away anytime soon. But inflation is only one side of the story. Let's talk about opportunity cost. When your money sits in a savings account earning 1% interest, you're essentially choosing stagnation over growth. Meanwhile, inflation-adjusted losses eat away at your net worth. That same $10,000 it could have been growing in low-risk, income-generating assets. But instead, it's trapped in financial quicksand. And that decision, repeated year after year, can quietly sabotage your financial future. And then there's the systemic risk no one likes to admit. Banks are businesses. They lend out your deposits. They invest them. And when those bets go wrong, as we saw with the 2023 banking crisis, it's your money that's at risk. Sure, the FDIC insures deposits up to $250,000. But what if the system itself buckles under stress? What if withdrawals are frozen, where your funds are temporarily inaccessible? These aren't conspiracy theories. They're precedents already happening in countries like Lebanon, Nigeria, and even parts of Europe. What's even more alarming is the rising trend of bail-ins, where failing banks use customer deposits to stabilize their balance sheets. Unlike bailouts, which use government money, bail-ins hit depositors directly. It's legal, it's documented, and in some scenarios, it's even encouraged. You might not lose all your money, but you may wake up to find a portion of it has been reallocated without your consent. And we haven't even touched on surveillance. With the rise of central bank digital currencies, CBDCs, and the decline of physical cash, governments are gaining unprecedented control over financial behavior. Programmable money could mean limited withdrawal windows, spending restrictions, or expiration dates on your digital dollars. In this future, your financial autonomy could be reduced to a set of rules written by someone else, rules that can change at any moment. Holding cash used to be a symbol of safety and freedom, but in 2025, it's becoming a symbol of exposure to inflation, bank risk, and even governmental overreach. If you want to preserve your wealth and maintain control over your financial life, it's time to rethink the role of cash entirely. Disruptive trends, changing the game, it's not just about inflation or banking instability. The entire financial world is shifting under our feet. If you're still treating money like it's 2010, you're not just behind, you're vulnerable. Let's break down 3 massive, disruptive trends reshaping the rules of money and exposing why cash no longer offers real security. First up, central bank digital currencies, CBDCs. These aren't a sci-fi concept. They're already live in over a dozen countries and actively being tested in many more. CBDCs give governments direct control over your money. They can be programmed to expire, restricted to specific purchases, or even turned off if you break certain rules. And unlike cash, there's no privacy. Every transaction is logged, monitored, and stored. The appeal for governments? Total control over the economy. The risk for you? A world where the freedom to spend becomes conditional. Second, AI and automation are disrupting the job market faster than we can adapt. Entire industries, from customer service to logistics to finance, are being reshaped or outright replaced by AI. As productivity soars, wages for many jobs are shrinking or stagnating. This is more than an employment issue. It's a ripple effect that impacts consumer spending, economic stability, and the safety of cash-based savings. If fewer people are earning, fewer people are saving, and that puts pressure on already fragile financial systems. Finally, we're seeing the acceleration of global de-dollarization. Nations like China, Russia, and members of the BRICS alliance are actively seeking alternatives to the US dollar for trade and reserves. While the dollar is still dominant, cracks are forming. If the dollar loses its reserve status, even slightly, it could lead to a decline in its value, further weakening the purchasing power of your cash. It would also raise the cost of imports, fuel inflation, and make cash a worse store of value than ever before. These aren't fringe theories or future hypotheticals. They're happening now, and together, they paint a clear picture. The traditional role of cash is being dismantled by policy, by technology, and by global competition. The smart move isn't to panic. It's to pivot, because when the rules change, so must your strategy. Safer asset number 1, short-term government bonds. When people think safe investment, they often think of cash. But ironically, one of the safest alternatives today is something your bank likely uses your cash to buy. Short-term government bonds, especially Treasury bills, or T-bills. Why are T-bills considered safer than holding cash? Because they offer a guaranteed return, backed by the full faith and credit of the government. Unlike bank savings accounts, which are vulnerable to changing interest rates, bank failure risk, and inflation erosion, short-term bonds offer predictable outcomes and increasingly attractive yields. In 2025, many T-bills are yielding between 4% and 5%, far outpacing standard savings accounts and even beating some high-yield savings. Another key advantage? Liquidity. These are not long-term commitments. You can buy T-bills with durations as short as 4 weeks. That means you maintain flexibility while still earning a solid return with minimal risk. It's like parking your money in a high-security vault that also pays you monthly rent. In uncertain times, that's a deal few other investments can match. T-bills are also exempt from state and local taxes, making them an efficient way to generate income, especially in high-tax states. For investors seeking stability, they're the gold standard, especially in volatile markets where preservation matters more than speculation. And here's a little-known fact. Large corporations and banks themselves use T-bills to safeguard their reserves. That's right. They don't leave billions sitting in checking accounts. They move that capital into these low-risk, income-generating instruments. If it's good enough for the Fortune 500, it's worth considering for your portfolio, too. While T-bills won't make you rich overnight, they serve a critical role, preserving capital and providing a yield that beats inflation. In an uncertain world, short-term government bonds are one of the few places where risk and return strike a balance. If you're seeking safety without surrendering gains, this is where to look first. Safer asset number 2, gold and precious metals. Gold has survived every empire, economic collapse, and currency reset in human history. While paper money has come and gone, gold has always held its value. In 2025, it's not just a relic of the past. It's a critical piece of the future, especially for anyone serious about long-term wealth protection. What makes gold so powerful? It's not someone else's liability. Unlike cash in a bank or a bond from government, Gold is a physical asset. It doesn't rely on a promise to be repaid. It doesn't crash because of bad management. And in a world increasingly driven by debt, algorithmic trading, and digital surveillance, that kind of independence is more valuable than ever before. Gold is also a proven inflation hedge. During periods of high inflation or currency devaluation, gold tends to rise in value. Over the last 5 years, as inflation surged globally, gold consistently outperformed many traditional assets. Investors turn to it not just for safety, but for resilience, because when confidence in fiat money fades, gold shines the brightest. There's also growing demand from central banks. 2023 and 2024 saw record-breaking gold purchases by central banks worldwide. Why? Because even governments know the importance of holding a real, tangible store of value. If they're buying it up by the ton, maybe it's time for the average investor to pay attention too. But it's not just about bars of gold in a vault. You can also invest in precious metals ETFs, mining stocks, or even digital gold tokens backed by physical reserves. There's a solution for every level of investor, from those who want to hold coins in their hands to those who prefer modern, paperless exposure through apps or brokerage platforms. And don't overlook silver, platinum, or even copper. While gold is the most famous, these metals play crucial roles in emerging technologies, from solar panels to electric vehicles, and could see explosive growth in the coming years as green energy infrastructure scales globally. The bottom line? Precious metals offer security, diversification, and protection against both inflation and systemic risk. They don't rely on tech, trust, or centralized systems. They've outlasted wars, recessions, and revolutions. And in the uncertain financial landscape of 2025, they still deserve a strong place in every smart investor's portfolio. Safer asset number 3. Bitcoin and digital assets. If gold is the ancient store of value, Bitcoin is its digital heir, a decentralized asset designed for the modern era. In a world where governments are creating programmable money and increasing financial surveillance, Bitcoin offers something revolutionary: self-sovereignty over your wealth. Unlike fiat currencies, Bitcoin isn't controlled by any government, central bank, or corporation. It operates on a global, decentralized network where rules are enforced by math and code, not political whim. Its fixed supply of 21 million coins makes it immune to inflationary money printing. That scarcity is part of what's driven its meteoric rise over the past decade, especially during times of institutional distrust and monetary instability. Critics often say Bitcoin is volatile, and they're right. In the short term, price swings are real. But zoom out, and the trend becomes clear. Bitcoin has outperformed nearly every other asset over the last 10 years. For long-term holders, the volatility is noise, not risk. And for those who value financial freedom, its censorship resistance is a feature, not a flaw. Digital assets go far beyond Bitcoin. Ethereum, the second largest cryptocurrency, powers a decentralized financial ecosystem worth billions. Through Ethereum, users can access DeFi platforms to lend, borrow, trade, or earn passive income, all without banks or brokers. This peer-to-peer financial system is becoming increasingly important as traditional finance grows more centralized and exclusionary. Then there's the rise of tokenized assets, representations of real-world items like gold, real estate, or stocks on the blockchain. These digital twins are making investing more efficient, accessible, and transparent. With just a few clicks, anyone can gain exposure to high-quality assets that used to be out of reach. Of course, there are risks: cyber attacks, scams, and regulatory uncertainty. But the ecosystem has matured. With cold wallets, audited smart contracts, and custodial insurance solutions, investors now have more protection than ever before. As with any investment, it's essential to do your research and understand what you're holding. In 2025, Bitcoin and digital assets aren't fringe or futuristic. They're essential tools in the fight for financial autonomy. For those who want true control over their wealth, not just the illusion of access, digital assets are a powerful hedge against the centralized systems of the past. Safer asset number 4. Productive real estate. Real estate isn't just about owning property. It's about owning income-producing assets that work for you 24/7. In 2025, productive real estate is one of the most stable and versatile alternatives to holding cash. What makes real estate productive? It's all about cash flow. Rental properties, multifamily units, and commercial spaces generate consistent income while appreciating over time. That's a double win. Recurring revenue and long-term capital growth. Unlike stocks or crypto, real estate offers physical utility. People will always need places to live, work, and shop. Even during economic downturns, quality real estate tends to hold its value better than paper assets. Why? Because it's tied to real demand. Population growth, urban migration, and housing shortages ensure that demand remains strong, especially in key markets. If you choose the right location, your property becomes more than an investment. It becomes a self-sustaining engine of wealth. Another major advantage is leverage. With relatively low interest rates on real estate loans, you can control a large asset with a smaller upfront investment. That amplifies your returns and helps you build wealth faster, especially when rental income covers the mortgage and operating expenses. Let's not forget tax benefits. Real estate investors enjoy deductions for depreciation, mortgage interest, repairs, and more, all of which improve your net returns. It's one of the few asset classes where the government actively rewards you for building wealth. There are also new models gaining popularity. Fractional real estate investing, REITs, and crowd-funded property platforms make it easier than ever for everyday investors to get exposure without buying an entire property. Whether it's residential, commercial, or vacation rentals, real estate offers a balance of stability, income, leverage, and inflation protection. When structured right, it becomes a cornerstone of a resilient financial strategy, one that's far safer than watching cash erode in a bank account. Safer asset number 5. Dividend-paying stocks and ETFs. If you want your money to work for you while you sleep, dividend-paying stocks and ETFs deserve a spot in your portfolio. These assets don't just sit there. They pay you regularly, while still offering the potential for long-term growth. Dividends are portions of a company's profit distributed to shareholders, and many of the most reliable companies in the world, think Coca-Cola, Johnson & Johnson, and Procter & Gamble, have decades-long track records of paying and increasing dividends. These businesses aren't exciting, but they're essential, and that makes them stable, especially during market turbulence. When you invest in dividend stocks, you're not just speculating on price appreciation. You're earning passive income regardless of market mood. That consistency is especially valuable during uncertain times, when price swings in other assets can be nerve-wracking. You're rewarded just for holding. Even better, you can access diversified exposure through dividend-focused ETFs like VYM or SCHD. These funds pool together dozens or hundreds of dividend-paying companies, spreading risk while still generating solid income. It's a hands-off way to benefit from some of the world's most stable businesses. There's also a hidden superpower, dividend reinvestment. By automatically using your dividends to buy more shares, you harness the power of compound growth. Over time, this can dramatically boost your returns without needing to invest more capital. And just like real estate, dividend stocks offer tax advantages depending on how they're structured and held. Qualified dividends are taxed at lower rates, making them an efficient source of income for many investors. In a world where cash offers nothing but erosion, dividend-paying stocks and ETFs are a practical way to preserve wealth, generate income, and build long-term financial resilience. They're not flashy, but they're financially smart. Safer asset number 6. Inflation-protected securities, I-bonds. In a time when inflation eats away at your savings like a slow-burning fire, I-bonds offer a simple, government-backed solution. Issued by the U.S. Treasury, these bonds are specifically designed to protect your money from inflation. And in 2025, that protection is more valuable than ever. Here's how they work. I-bonds earn interest through a combination of a fixed rate and a variable rate that's adjusted every 6 months based on the Consumer Price Index. That means as inflation rises, so do your returns. When traditional savings accounts lag behind the cost of living, I-bonds can help you stay ahead. They're also low risk. Backed by the U.S. government, they're about as secure as an asset can get. There's no market volatility, no fees, and no risk of losing your principal. And while there are limits on how much you can invest annually, currently $10,000 per person, They're perfect for preserving the purchasing power of emergency funds or medium-term savings. If you're looking for a straightforward way to protect your cash from inflation's bite, I-bonds are a smart, stable choice. They won't make you rich, but they'll keep your money real. Safer asset number 7. Private equity and alternative investments. When traditional markets feel shaky and cash feels like a liability, many wealthy investors turn to private equity and alternative investments, assets that operate outside of public stock exchanges but often deliver strong, consistent returns. Private equity involves investing in privately held companies. Think startups, growing businesses, or even distressed companies with turnaround potential. These opportunities are often inaccessible to the average investor, but they're where serious wealth is built. Because you're buying into a company before it's public, the potential upside is massive if that business succeeds. Alternative investments go beyond private companies. They include venture capital, real estate crowdfunding, private credit, hedge funds, art, wine, and even collectibles. What ties them together is that they're less correlated with public markets, which means they often hold up better during downturns. One of the biggest advantages? Access to alpha returns that beat the market average. While these investments can carry higher risks and require longer holding periods, they also offer better insulation from short-term volatility and economic shocks. The barrier to entry is shrinking, too. Thanks to platforms like Fundrise, Masterworks, and AngelList, investors can now participate in deals that were once limited to ultra-high net worth individuals. Some platforms allow you to start with just a few $100s. Of course, due diligence is critical. These assets are less liquid, less regulated, and require more research. But for those willing to dig deeper, they offer a powerful hedge against the limitations of traditional investing, and a smart place to park wealth when inflation, bank instability, or currency shifts make cash too risky. In 2025, having exposure to alternative assets isn't just a luxury, it's a strategy. If you want to invest like the wealthy, start thinking like them. Go beyond the banks and the stock market. So let's bring it all together. If you're still keeping most of your money in a traditional savings account, you're exposing yourself to silent risks: inflation, devaluation, and systemic instability. The cash you think is safe may be quietly losing value every single day. But the good news? You have options. Real, practical, diversified options. From short-term bonds and precious metals to Bitcoin, real estate, dividend stocks, and even alternative investments. These are not just fancy assets for the rich. They're smart financial tools that anyone can begin using today to protect and grow their wealth. The key isn't to go all in on any one asset. It's to diversify strategically, align with your goals, and avoid the trap of thinking cash is risk-free. Because in 2025, the real risk is standing still while the world changes around you. Now it's your move. Look at your portfolio. Where's your money parked? What could be working harder for you? And most importantly, what's keeping your wealth safe? If this video gave you new insight, hit that like button, drop a comment below with your biggest takeaway, and subscribe for more strategies to stay ahead of the curve. Your future self will thank you.